Let's start with Ray Dalio, who arguably is more famous than ever and has been more vocal than ever and is underperforming, losing money for the first time since 2000.
That's exactly right. And putting that into perspective, that's coming off a really good year the year before. So what does this all mean? Since it started in 1991, it had an 11.5% annualized return. Since 2012, that dropped to way less than 5%. So really, in recent years, their overall performance has been really lackluster. Not to mention, Bridgewater has a lot of change right now as a whole. Remember, Eileen Murray has left and David McCormick is the sole CEO. So kind of moving forward here, the future of this fund and where it falls into the broader strategy of the firm will be interesting.
There's also a larger question facing hedge funds here with respect to this issue, because Ray Dalio was almost immune. Bridgewater Associates was considered sort of this revolutionary fund that could always gain no matter what, right? And that's how it attracted such assets. Does this sort of suggest more at the luck and, the time running out for the strategy, or is this just everyone has a bad year?
Macro strategies have started to bounce back a little bit, so this is a little bit specific for sure. If you look at some of his competitors, Brevin Howard had an 8.4% return on its main fund. Greg Coffey at Kirkoswald had 29%. Element Capital has been doing really well, so there is disparity in these hedge funds. With that said, you're talking about immunity. This fund is close to new capital and with a wait list of about $5 billion, according to Bloomberg's Kathy Burton, who reported about this in December. And so, and what did people say about it? It's Bridgewater, it's institutional, it's safe. And so even though they had lackluster performance the last couple of years, that hasn't stopped a wait list of money waiting on the sidelines.